So as promised, I'm going to do the real estate show, the real estate update show on real estate markets. Now, a lot of different real estate markets make up the US real estate market, but right now, if you just look at the macro real estate data, it's actually looking pretty good, but I'm going to talk about stories beneath the surface and also provide you guys with some audio clips that in specific markets, things are not as good as they appear, and they're actually getting worse in the United States. So the global macro, the large picture macro US real estate data, the home builders index, the SPDR home builders ETF, which is XHB, Xavier, Harry, Brian, is up quite a bit from the end of 2018, early 2019. It bottomed, the shares bottomed of that around $30.74, and it's rallied up to $43.35. So the home builders index is doing well, and the other index, which is a lot of people track, especially Wall Street and the business community, is the S&P Case-Shiller U.S. National Home Price Index. And the Federal Reserve, the Fed, St. Louis Fed even tracks this. And the home price index for Case-Shiller was going down a lot, obviously, during 2007, 8, and 9. It actually continued. A lot of people aren't aware of this. It actually continued through 2009, down from 150 in July of 2009 at 150, down. It got as low as 134 in February of 2012, before the Case-Shiller Home Price Index has started to rally. And really, since 2012, it's been almost straight up with very few exceptions. Right now, the S&P Case-Shiller Index is at 211.715. So it's had an absolutely, and this tracks like the index tracks the real estate prices of a lot of cities in the United States. And I believe the highest price appreciation in the last 12 months is out of Phoenix, from what I was looking at with articles. So you've had a big rally in this Case-Shiller. This is the macro index that people track for real estate prices. Obviously, real estate is local. So people are on the local, the real estate agents and the other people locally are going to know more about their market. But the countrywide index that people track is saying that the home prices has gone up in the United States a lot since 2012, an enormous amount, about almost a doubling. So beneath the surface, though, recently there are articles that the large U.S. banks, the mortgage lenders, are becoming more and more desperate to try to either extend the real estate bubble or grow the real estate bubble. And my best friend, who is a local real estate agent here in the DC metro area, sent me these articles, so shout out to Dan. This article was from September 10th, 2019 from housingwire.com. This is from Ben Lane, and it's Wells Fargo, Bank of America, Quicken Loans, others want the DTI requirement eliminated from QM lending rules. So there was a cap. There's the rule also includes a stipulation that a borrower's monthly debt to income ratio cannot exceed 43%, but that condition does not apply to loans backed by the government, the FHA, the Department of Veterans Affairs, and the Department of Agriculture. Fannie and Freddie are not bound by that requirement either, a condition known as the QM patch. Under the QM patch, loans sold to Fannie or Freddie are allowed to exceed the 43% debt to income ratio, but it seems now last month, so about a month ago, Wells Fargo, Bank of America, Quicken Loans, and Caliber Home Loans joined with the Mortgage Bankers Association, the American Bankers Association, the National Fair Housing Alliance, and others to send a letter asking this agency to eliminate the 43% debt-to-income ratio cap on prime and near-prime loans. So they're trying to get people who have worse debt-to-income ratios mortgages, saying that they would still give them approval. And then recently, a couple days ago, there was another Housing Wire article that came out by Ben Lane as well on October 8th. And if you want to read this more in depth, you can. But it's now beginning yesterday on October 9th, 2019. Certain home sales of $400,000 and under will no longer require an appraisal. Under previous rules that have been in place since 1994, appraisals were not required on all home sales of $250,000 and below, but last year, federal regulators proposed increasing the appraisal threshold for the first time in 25 years. So it sounds to me like the banks are becoming more and more desperate. There's also a story from August that the banks are now starting to roll. Zero Hedge reported on this, that the banks are starting to, let me see if I can find, I have so many windows open, that the banks are now starting to roll out more mortgage-backed securities. This is from MarketWatch on August 20th. Credit Suisse and Citigroup joined other major banks in mortgage bond revival with a twist. So the non-qualified mortgage bond supply could hit 21 billion this year. Credit Suisse and Citigroup are moving back into a corner of the mortgage market where new home loans to borrowers with imperfect credit are being packaged into private bond deals. The two banks are following the lead of JP Morgan Chase and Wells Fargo, which have already restarted similar programs to expand credit to homeowners, including using alternative means to verify income. That might bring to mind ninja loans of the past, where mortgage loans went to borrowers with no income, no job, and no assets, hence ninja. But investors say the new breed of mortgages and bonds are a big improvement from the old subprime market that imploded in the 2008 financial crisis. Quote, we continue to be excited about and focused on developments within the next generation non-agency mortgage markets. Greg Parsons, chief executive of Subprime Capital Management, a $3 billion fund with a mortgage bond focus, told MarketWatch. Citigroup and Credit Suisse are prime examples of issuers, bank institutions that traded these non-agency mortgage securities during and after the crisis, and they have remained involved in various facets of issuing transactions within mortgage sectors. So if you want to read more of the article, you can, talking about how these are starting to be issued more. The amount that they're being issued is starting to grow again. Now, Danielle DiMartino Booth, she's been tracking real estate extensively. She does this full time. She tracks a lot of different markets. She's been warning about the commercial real estate bubble for years now, and it hasn't popped. Although there are some red flags, WeWork is one of them, the unicorn IPO. If you're not familiar with WeWork, there's an article out that Zero Hedge put out, and also another finance professor authored by Henry Hawkesbury and another finance professor in New York City, going through details how WeWork's a fraud. WeWork is pretending to be a technology company. They have all these software developers, but really it's a real estate company that buys commercial real estate and then sells entrepreneurs or small business owners smaller amounts of office space and charges them higher cost per square foot. And the WeWork company, which had a higher valuation, and there's a lot of evidence that SoftBank was, let's just say, doing a lot of very shady or potentially fraudulent things to raise the valuation. But despite WeWork charging entrepreneurs more money per square foot, they still could not make money. So they were overcharging entrepreneurs to rent smaller amounts of office space. They were charging them more money per square foot, and they still couldn't make money. So they're charging higher margins than someone renting normal commercial real estate. They were overpaying for real estate, and they still couldn't make money. And it looks like WeWork is not going to go IPO, and the company's going to stay private, and there is a lot of other trouble. The CEO and his girlfriend or wife, there was a lot of shady financial stuff, worse than even Elon Musk, I think, in some aspects. And they were raping and pillaging the company. There's a lot of shady stuff at WeWork. I don't know how deep you want to go into it, but it's a microcosm of the commercial real estate markets. So Danielle DiMartino Booth also, besides covering commercial real estate, she just put out an interesting piece today for Bloomberg, an op-ed called "The Housing Market's Rebound is No Mirage," talking about how lower mortgage rates are near record lows, making buying a home more affordable, according to Freddie Mac 30-year mortgage rate data. And this sounds bullish. This article sounds bullish on real estate. However, and this is the thing with Danielle DiMartino Booth, and I respect her. I think she's very smart, but sometimes she does really, really conflict herself, because I'm going to play a clip here for about 2 minutes. This interview she did with Hedgeye a couple weeks ago, and it was released on September 26th of 2019, and she's talking with I'll briefly summarize the beginning of it here. She's talking with Keith McCullough, who's the founder and CEO of Hedgeye. He was a big shot hedge fund manager. He owns a successful research company for Hedgeye. I don't know if they manage money, but they provide very expensive research products. So they were talking about the real estate market here in this 2-minute clip, and what she says during this 2-minute clip that I'm going to play, it contradicts her Bloomberg article that came out today. So let's listen to it.
It's an amazing thing. And it's pro-cyclicality at its best. If it wasn't late cycle, none of these things, first of all, happen.
No.
And people always go back to 2016 with me and they say, hey, look, 2016, it's like earmuffs. I mean, 2016 was actually a mid-cycle slowdown. And we had the biggest stimulus in the history of China, which kind of matters. And we had Janet go dovish, drop the dots, dollar down, which allowed the Chinese to stimulate faster and more aggressively. It's not even close to 2016.
Nope.
Did
And you had this massive tailwind of residential real estate in 2016.
Yes, good point.
You've had a 100 basis point decline basically in mortgage rates, and you've not seen near the traction you theoretically should have seen.
Yep.
Because house prices are too high.
Mm-hmm.
Mortgage Bankers Association came out with fresh data just a few days ago that shows lending standards for mortgages are tightening in a falling mortgage rate environment.
Yeah.
I mean, none of it makes sense.
It's actually been, I mean, I just went through it, so like a non-idiot, I refinanced. Okay, duh. You have a call that interest rates, like, Tony, we're going to go to all-time lows here, was the view. So my wife and I kind of go with the view, and we refinance. They looked at me like, they looked at my personal, like, I'm not going to name names, to the investment bank that I flipped to go to the better rate, because they're giving you ridiculous, if you put this amount of capital into your new account, we're going to give you this teaser rate, your interest rate for 6 months, which is a money-losing thing there. I was like, this is all cool, until they actually started to go through the review. My file had to get reviewed by a new group. Mine. Because they have this thing that basically says, well, we have to look at the LLC's profitability. I mean, are you kidding me? I mean, this is ridiculous. The amount of money I just put in, like, there is a high bar to get is my point. I'm not trying to big time anybody here and say, hey, look, it's just that you can't just go refinance.
No.
There is an extremely high bar, and there's a long duration to get what you think you were going to get.
And yet refinancing applications are up, what, like 170%
Apps
year over year?
But
apps are
apps.
up. Apps are up.
The difference between apps and the new disclosures you have to provide are, I was dumbfounded by this.
Believe it or not, the realtors have a lobby in Washington. So
Really?
it's really hard to get your hands on the fail rate of mortgage bankers. Will tell you all day long that applications are up. They will not tell you, what the percentage of them is that fail. If anybody has that information, please send.
Yeah.
So, because that's the differentiating, even for purchase applications.
Yep. Well, mortgage purchase applications, that's been one of the more bullish charts because it couldn't have been more bearish when rates were rising.
Sure.
But, I mean, everybody kind of got that one.
But again, I mean, I graphed it out a few weeks ago. Even that is not showing as much traction as it should from the decline in mortgage rates.
Yeah, well, I mean, so how does what would...
Okay, so, again, there's the contradictions from Danielle DiMartino Booth, because 2 weeks ago she didn't sound as bullish on housing, and then today the article comes out on her Bloomberg piece that it sounds like housing is doing well. So, I don't know, take it for what it's worth. It sounds to me like beneath the surface there's a lot of problems. The stuff I took away from those 2 minutes was that mortgage refinance applications are up enormously. They said, according to the data, that they were looking at 170% increase in mortgage refinance applications. However, the amount of people actually being approved for mortgage refinancings is down a lot. So the banks are not actually approving people to get their refinancing, and it sounds like the process to get refinanced is much, much more difficult than it was in the past. I think my dad got his mortgage refinanced maybe like 2010, 2009 or 10 or 11, somewhere in that time frame, after Ben Bernanke took interest rates down with ZIRP, zero interest rate policy. And I believe it was fairly straightforward, and the banks that he did the mortgage refinancing with, they wanted like a check for like $10,000 or $20,000 or something as part of the application process. It sounds to me like the refinancing application process is extremely more cumbersome, more thorough than it was in the past. So they're not just handing out these refinancings like candy like they were in the past, although the banks are trying to reflate, extend the real estate bubble and reflate it, keep it inflating in different ways. So, like I said, beneath the surface, there is evidence that the real economy, that local real estate markets are not doing well. I found this blog article from September 25th of 2019. It's from adventuresincapitalism.com, and it's about the Miami real estate market. So Miami has a highly cyclical property market where the magnitudes of the booms and busts dwarf anywhere else in the country. In the author's experience, trends in Miami real estate also tend to lead national trends by a few quarters. Therefore, smart guys watch Miami. Roughly a year ago, the author noticed that Miami property prices started to decline after a 2 or 3 year period of leveling off. The pace of decline has clearly accelerated recently. Most properties on South Beach, where the article author lives, are up by 20 to 35% from peak prices, but that is nothing compared to the carnage across the bridge in areas like Brickell and Edgewater. So why are prices dropping? It's more than simple supply and demand, though the glut of new supply is clearly part of it. Rather, your typical condo has a carrying cost of 4 to 7% of fair value before financing costs, which include property tax, condo fees, insurance, maintenance, special assessments, etc. This adds up fast. When a property is worth hundreds of thousands or even millions, it is pretty much mathematically impossible to have a positive yield from buying and renting out a Miami condo. So he's the article author, trust him, he's done the math many times trying to find a rental property to do so. The only way owning is viable is if prices go up and allow you to extract capital to fund the carrying costs, though debt service then makes the monthly cash flow even worse. The basic law of Miami condo pricing is that if prices stop going up, they collapse due to the carrying costs. Suddenly, it seems as though a lot of owners are becoming financially distressed, forcing them to hit bids at a time when demand is somewhat lacking. With all that in mind, drinks last weekend with a buddy in the hard money lending market to discuss the state of the local Miami real estate market. And the hard money lending, for those of you not familiar, are where loans are made on the basis of the asset value, not the ability of the borrower to pay. So in fact, in some cases, it is assumed that the borrower will not repay the loan, and through penalty interest, you rapidly chew through their equity and get to own a high quality property at a great initial entry price. So this works well in an up market. And how does it work when things go no bid, when there's not as much demand to buy real estate? So this friend tells a story there about how things in Miami are getting worse. And if you want to read it, read more of the story. The article's there, but it seems that property taxes and other things are drastically slowing down demand for houses in Miami. And I'll attach a link to this article in the information description section. The rest of the article is in a conversational format, so he just typed the responses between him and his friend. But it's interesting stuff, and it shows you that despite the Case-Shiller index going up, beneath the surface in local markets such as Miami, also in markets like Silicon Valley and San Francisco metro area, things are also beneath the surface not as good as they would seem. And a lot of that has to do with the unicorn IPOs like WeWork and others that are having problems. I'm going to play another 5-minute clip in a second from Wolf Richter of wolfstreet.com. He has a podcast that he's been recording audio for his articles. I'm going to play this. This one's from last week. This is he spends an enormous amount of time studying the San Francisco real estate market because he's from there. So he puts out a lot of articles tracking real estate in general, but more specifically Silicon Valley real estate and San Francisco real estate, San Jose area, because he lives around there and he has a lot of contacts around there. So it's worth sharing this audio clip with you guys. Again, if you want to listen to the whole thing, the links to this will be at the end of the video, after the show's over.
And this IPO massacre is starting to show up in the spots that uniquely depend on this moolah, though most places in the United States and the overall economy might not even feel the tremors. But here in Silicon Valley and San Francisco, the tremors are real, and they've started to show up in the numbers. In house prices, for example, in the San Francisco Bay Area, which encompasses 9 counties and includes Silicon Valley and San Francisco, but also the East Bay and the North Bay, the median house price in August was down from August last year. It was the 5th month in a row of year-over-year price declines, a phenomenon we just haven't seen since the housing bust. So far, this has been a very gentle decline with ups and downs, compared to what happened in late 2007 through 2011. Today, it's an entirely different scenario for now. The NASDAQ is still near record highs. And this is a biggie. San Francisco and Silicon Valley are tightly linked to the NASDAQ. But at 79.39 on Friday, the NASDAQ is down a tad from September last year. It dropped about 20% late last year and has since recovered. Despite these gyrations, it has gone essentially nowhere in 12 months. Venture capital firms are still funding companies on a daily basis, though the exit doors are now more difficult to get through. But the Chinese investors are gone, both in real estate and in tech. Smaller scale layoffs have been happening. There's Uber and NIO, Schwab, Huawei, PayPal, Oracle, SAP, and others. Companies are still hiring, but those layoffs are signs that companies are getting more circumspect. Everyone around here who has been through this before is preparing for a local downturn. John McNellis, a commercial real estate developer in Palo Alto, shared, as he says, his loafers-on-the-ground glimpse of Silicon Valley. In his essay, he cites a mortgage broker who says, the Valley's for-sale housing market has seized up. Its volume way off from what it was in the spring. Why? The Chinese are gone, and the investors are sitting on their hands. They smell blood in the water. Sure, prices are coming way down. The only ones buying are people who actually need a house. In other words, speculation has gone out of the market. The deeply troubling phrase, the only ones buying are people who actually need a house, means that the housing market has returned to some sort of normal. And McNellis adds, ruining a normal housing market is laughable, but it hasn't been seen in Palo Alto since 2009. He cites a high-end residential sales broker who said, the market just disappeared the last 60 days. We're in a mini recession. The broker thought, however, the market would return in the spring. McNellis cites two project managers of new large-scale apartment projects. Both admitted they were only achieving their pro forma rents by giving away significant free rent on signing. And McNellis adds, I can tell you firsthand that our office leasing market has cooled. WeWork, which has come to dominate the office market in major cities, is sending tremors through commercial real estate. SoftBank, which plowed tens of billions of dollars into some of the companies I mentioned earlier, including Uber and WeWork, is a wild card for the Bay Area. A major problem at SoftBank would really spook some folks here. SoftBank has been a huge force in Silicon Valley and San Francisco in inflating everything, as I like to say. It has brought in an enormous amount of international money, and more money has ridden in on its coattails. WeWork is headquartered in New York City, but repercussions of a WeWork problem will be felt more in Silicon Valley and San Francisco than in New York City via the SoftBank connection. The money flow into the area via startups would just dry up. Startups spend this international money locally. They hire locally, pay high salaries to locals, and lease fancy offices and buy furniture and equipment and local craft beer. And their employees rent or buy housing in the area, and this has driven the market into frenzy for years. But the hot air is now coming out. A Bay Area downturn could be an isolated thing, not impacting the overall economy in a big way, at least at first. If the Bay Area downturn becomes a California downturn, including Southern California, it would get more serious nationally. Meanwhile, we're just here watching this unfold ever so gradually in tiny baby steps.
Okay, so I think that's enough. Played about 3 or 4 minutes of that. Really, really great insights there on the San Francisco, San Jose market, giving you great insights on the real estate market there, and also the Silicon Valley unicorn bubbles. The WeWork overpaying for commercial real estate in New York City, in London, in Silicon Valley, in so many different areas. They've drastically overpaid for commercial real estate in many different areas. So WeWork getting worse and worse problems, and maybe having to dump real estate that could exacerbate problems and cause local governments that wanted higher property taxes, that could cause them problems too. Also, I would point out, like I said, with the with the macro data, the U.S. macro real estate data, it's not showing that There's problems in local real estate markets in Miami. There's problems in local real estate markets in San Francisco, San Jose. It's still going up. The Case-Shiller index is still going up. So this is why you have to, if you're going to be a real estate investor, you're going to really understand the market, especially they say all real estate is local, you're going to have to study the local markets. And it sounds like there is a lot of problems beneath the surface in Miami and a lot of developing problems beneath the surface in San Francisco. I heard anecdotally from another friend last night that a property, I think, in the suburbs of San Francisco, I think it was selling at one of the houses next to it was selling at $2 million a few years ago, and then only a couple years later, recently, a property next to it sold for $700,000. So there are warning flags. I'm not sure if all the data, especially the national data, is capturing this. Now, what Wolf Richter brought up, and he covers real estate way more than I do. I just dabble in a little bit. I read some articles. I patch things together and occasionally do a show like this for you guys where I'm quoting clips. There is contrasting stuff, like I said, with the Danielle DiMartino booth, where you had a positive real estate article from her come out today on Bloomberg, and then 2 weeks ago she didn't sound bullish at all on real estate. She was criticizing and bringing out the bear stuff. So it's confusing to me. Now, what Wolf Richter did mention, I think this is important, he talked about the speculators leaving Silicon Valley, the real estate speculators. What I would say, and this is based on me talking with my best friend extensively, who is a very good real estate agent in this area, and the information he is gathering is a lot of the speculative capital that has left Miami, that has left San Francisco area. Guess where it is coming? It is coming to the Washington, D.C. metro area, and more specifically, it is coming to Arlington County, right around Amazon. So there is incredible amounts of speculative capital coming here to the Washington, D.C. metro area because Amazon is opening up their second largest, I believe, headquarters here. So there is, I think the inventory levels here are down enormously. There's almost no inventory in certain instances for certain types of houses. And the construction cranes are literally everywhere. They're knocking down old strip malls. They're building further and further away, more expensive condos and single-family homes. If you do come to the Washington, D.C. metro area where I am right now, you will notice if you drive around for at least like 20 or 30 minutes, you don't spend it in one area. You drive around the area. In the Northern Virginia, Maryland, D.C. area, you will see nonstop construction cranes. So that is part of the government bubble, the big government bubble, and also the housing bubble. So the speculative capital that is leaving other markets, it is coming here to Washington, D.C. And it is betting on higher prices, the greater fool theory, I guess, for Amazon, that Amazon employees will be moving here and they will be willing to overpay so they get a house. The average person cannot afford a home, but there's still people with money. There's foreigners with money. So there's still people with capital. Yeah, the average person is going to be crowded out. Rent is very high in this area. They're putting dividers. I was reading an article in the last couple of years that in basements in Washington, D.C., they're actually putting like curtains up in basements, and they're putting like a cot. So there's like a cot there, a bed or a cot, and then curtains and like a couple like dressers, and they're charging people like between $800 and $1,000 a month for that. I was playing audio clips, which I think are very relative, very appropriate for the topic of covering the real estate market here in the U.S. No, Amazon's not paying for the real estate though. Amazon's actually buying up cheap, dilapidated real estate in old parts of Alexandria. There's bad parts of Alexandria where it looks like I drove through it a few weeks ago when I was getting a new phone. And some of it looks like it hasn't been updated since the 70s or the 80s. So they went and they're buying up cheap real estate in like Old Town Alexandria or other parts of Alexandria, and they're going to be renovating that. So there's massive amounts of speculative capital coming here, specifically into the Arlington County and Alexandria area, like Crystal City. Wow, got a lot of super chats. Thank you, guys. So Mark Kessler asks, what do I think of Mark Dow and his assertions about Austrian school economics? So, Mark, I'm not sure if you're familiar with Mark Dow. First of all, Mark Dow is a very mainstream person. I believe he was Assistant Treasury Secretary under Obama, and he was an academic and worked on Wall Street. He was, I think, a manager at one of the large Wall Street banks. So he is very mainstream. He is very Keynesian and neo-Keynesian. He hates I have screenshots from him. He hates libertarians. He hates Austrian school economics, and he hates gold. So his bias is ridiculous, and I'm pretty sure he totally missed the 2008 financial crisis. So if you want to listen to Mark Dow, you listen to him at your own peril. Let's just say he loves criticizing anyone who disagrees with him. He's one of these intelligentsia, Wall Street academic a-holes. I'm not a fan. I think I got in a Twitter fight with him years ago. His tweets, every couple weeks or every month or two, he just randomly decides he wants to put out a tweet about how much he hates libertarians, how much he hates gold, how much he hates anyone who owns gold, and how much he hates Austrian school economics. I bet he knows no Austrian school economics. Pretty sure he doesn't know any. Because I've seen some of his tweets, and yeah, he doesn't know anything. What he quotes and he thinks he knows about Austrian school economics, he doesn't really know. It's like people who say that they hate libertarians and you ask them, well, or they hate capitalism, and then you ask them for a definition of capitalism and they don't even know what capitalism is. Or they say they hate libertarians, but they don't know what a libertarian even is. That's what I think of Mark Dow. Mark Dow is a rich, status quo, intelligentsia, Wall Street type. He worked directly in the Treasury Department under Obama. I believe he was Assistant Treasury Secretary. Okay, next live stream super chat. Thank you, Kenneth. I appreciate it for the super chat. $40. Very nice. And thank you, Bjorn. The new documentary Push. What is Push about? I've never heard of it. What is Push about? So the large Wall Street banks, some of the mortgage bankers, they're starting to get worried. So even though the Case-Shiller index looks good, the home builders index looks good for now, it did have a period of time, let's see here, let me look back on the charts, where from the end of August, early September 2018, it crashed a lot down to end of December of 2018. But here's the thing. This is not financial advice, just my opinion. If you're going to short the home builders index, do not expect the home builders to all go to zero. Because it is part of policy for U.S. Congress, Republicans and Democrats, to agree that they want to subsidize and bail out home builders. So a lot of people aren't aware of this. Everyone knows about the bank bailouts in 2008 and how AIG got bailed out. They're viewed as systematically important. GE Capital got help. General Motors, their financial arm, General Motors financial arm had problems too. So everyone knows about those. But most people aren't aware that Congress had rules changes for the home builders. So the home builders were actually about to go bankrupt in 2008, and Congress started giving them the ability to change their accounting, started giving them subsidies, started giving them tax breaks. So yes, this is just my opinion. So yes, home builder shares can go down a lot. They can go down 20, 30, 40, 60, maybe 70 or 80%, but they're not going to zero, because at some point, Republicans and Democrats, and this is one of the few issues that they can agree on, they will agree that the home builders will get a bailout. That is because the National Realtors Association and others have very powerful lobby here, federal lobbying here in the DC metro area. So do not expect all of the home builders to go down to zero. Some of them may go bankrupt. Just my opinion, some of them may go bankrupt. But Congress will not allow all of them to go to zero. They will change the rules. They will bail out. They will change the accounting rules. They will get subsidies. Trump may even, because Trump wants veterans to have homes, Trump may even give the home builders, as some type of infrastructure package, he may give the home builders some contracts to build cheaper housing for American military veterans or something. That would sell very well. That would sell very well with Trump's voting base, with Trump's pro-military voting base. So the banks are starting to do really crazy stuff again. The debt to income ratio that caps it cannot exceed 43%, is designed to protect the mortgage borrower from borrowing too much of a house, too much mortgage, so they don't get themselves in financial trouble. And the banks are getting that, actively working through lobbying and other means to get that removed. And now the appraisals, the banks are trying to get no appraisals on higher home prices. So more shady tactics from the bank, and the mortgage derivatives, the real estate derivatives, are starting to become popular again. And that is because the central banks are doing financial repression, Japanification. They're taking away people's ability to earn yield, to earn interest on their savings. Insurance companies, pension funds, savers, retirees, people need income on their savings. If they do not earn any income, any interest, the odds of them being able to retire are going to be very low. You cannot compound wealth. So that's why you have these entities like American insurance companies, banks, and pension funds that are so desperate for income, so desperate for yield, because of central banks with financial repression and zero interest rate policy and negative interest rate policy. That's why they're buying collateralized loan obligations. Which I think collateralized loan obligations, the Bank of International Settlements spent a lot of time warning about this, that collateralized loan obligations are going to be the subprime mortgage-backed securities of the next crisis. It's looking like that. There's a lot of warnings coming out about CLOs. The Federal Reserve wrote a paper. I covered this in the last 2 months. And now the Federal Reserve wrote an extensive paper talking about how the banks even ship these things off to the Caribbean to be chopped up to limit legal liability. And then it's being bought by like Japanese banks and pension funds and U.S. insurance companies. And then the Bank of International Settlements, only a couple weeks ago, spent an extensive amount of time writing about CLOs in their quarterly September 2019 Global Macro Update. Do you mean residential rent or commercial rent, Mark? The politicians, Mark, other than rent-controlled stuff, the politicians want rent up. They want all real estate prices and rents up, because then that means more taxes, more tax revenue. There's screwed up incentives, not just in the United States, but in Australia. And Australia has an enormous housing bubble. Mar North and others cover this extensively. But there's really perverse incentives to allow bad money to go in and buy real estate, and the politicians don't care as long as it forces home prices up, and that means the politicians do not have to cut their government budgets, they don't have to cut spending, and that means higher property taxes. So the average person's getting hurt. So even though property prices are going up, property taxes are going up too. Oh, I'm not running... thanks for suggesting I run for president. I'm not running for president. No, thank you. So the games are starting to accelerate. I sent these Housing Wire articles to Danielle DiMartino Booth when they first came out. So the one from September 10th, I sent it to her on Twitter. And she said back then, so this was a month ago, she said it's too late in the cycle for the large U.S. banks and mortgage lenders, mortgage bankers, to try to keep the real estate bubble going. That was her opinion then, but it looks like with her new article that just came out from Bloomberg, her opinion might have changed. A lot of millennials can barely afford rent. They can't buy their own car. Why do you think they're voting for socialism? Ricky, who knows how they're going to do the bailouts? We don't know if they're going to publicly announce them. We don't know if they're going to do them secretly. We don't know. The one major thing that's going to happen is the rules are going to change. They're going to change the rules. There could already be emergency meetings now with the banks and the insurance companies. We know of 2 emergency meetings just since Christmas Eve of 2018. There's probably been more. Yeah, well, Tilray shares crashed, so they're down enormously. Beyond Meat, I expect, will probably eventually crash too. I haven't looked at the stock lately. This is an interesting comment here in the live chat from Housed Portalents. Hundreds of thousands of Americans are squatting, not paying mortgage, and banks refuse to foreclose on properties as there are too many to foreclose on and will only bring down the housing market. Well, the counter argument to that is the U.S. allows foreign investors to come in and overpay for real estate. The same thing happened in Vancouver. Same thing happened in Australia. So that's why these governments are allowing, let's just say, shady money to come in and buy real estate. So even though Americans can't afford the real estate, someone can afford the real estate and overpay for the real estate and then pay the property taxes. Because the governments do not want to cut their government budgets. Look, I've had discussions with Democrat politicians in local politics in the past, and these politicians, and I've heard stories from friends too about politicians in Illinois and elsewhere, these politicians are totally freaking delusional. Okay, these politicians just think that property taxes can be raised perpetually, and that they do not need to cut government spending. They think that new taxes can be layered on, whatever, like a sales tax, restaurant tax, tourist taxes, for rental cars or hotels, if it's in a tourist area. You know, all these new taxes can be layered on, and that won't affect tourism. So they think if they increase tourist taxes 10, 15% higher, that won't affect tourism. They think that if they raise property taxes every year or every couple of years, that won't affect the amount of owners of properties. This is the mindset of a politician. And it's not just a few politicians who think like this. It's pretty much all of them. The Democrat ones are the worst, though. Delusional is a word I would use routinely. I've had discussions with them about taxes. And this is the MMT people. The MMT people are delusional in a lot of aspects. Your property taxes went up 8% last year. And let me guess, did your income go up 8%? So if your income didn't go up 8% and other taxes also went up, then your standard of living declined. And this fits in with my stagflate and tax and lie narrative. The governments are claiming there is no inflation. But there is inflation. Currencies are being devalued. People are getting less goods and services for more fiat currency. And then new taxes are being layered on, and old taxes that were already there are being increased. Welcome to dystopia. Yeah, the average person can't keep moving all the time, though, to lower their tax bill. The average person can't do it, especially if you have like a wife and kids, or a husband and kids, and younger kids. Yeah, the average person can't routinely move to lower their tax bill. Well, I've spoken with Democrats, Ricky, who think the governments are honest. But they haven't studied history. Governments lie all the time and only tell the truth when it's convenient. And normally they do everything they can possibly do or say, and then it's the truth at last, normally. I got in an argument with the editor-in-chief of the Toronto Globe and Mail business section, and he didn't know anything about American history and was trying to tell me how good of a president FDR was. The guy literally knew nothing about American history. He was trying to tell me how great of a president FDR was. And I was telling him all the different things FDR did that were total lies, hypocritical. I mean, FDR caused a lot of people to die during the Great Depression in 1929. A lot of people killed themselves because of FDR's policies. And then also got the U.S., he tricked Japan to attack with Pearl Harbor. There's a lot of documents about that now. Yeah, this is a Canadian trying to lecture who only knows the basics, that FDR saved the U.S. from the narrative, I guess, that he understood was that FDR saved the world from the Nazis. But the truth about FDR is much, much worse. FDR and Woodrow Wilson are the two worst modern presidents in history. Oh, FDR was on the phone with Benito Mussolini daily before World War II. I mean, he was really good friends with Benito Mussolini, from what I've heard. There was daily correspondence, I believe. Okay, well, I think that's enough for right now. If you want to take a look at the sources, the articles, go more in depth on this, you can. And I know I have a lot of real estate professionals who listen to this podcast, so you can put your comments about your local real estate market, about how the speculative capital is leaving, or the real estate bubble in your area is starting to slow down, or how politicians are, despite real estate prices falling, politicians or not going up as much, politicians still want to layer on more property taxes. You can put that in the comment section under the video after it's over. I want to thank everyone who is a Patreon account contributor. I have, I think, around 160 now. It's over 150, starting to grow very rapidly. Hopefully I'll be at 200 in less than 6 months. The dozen or so monthly PayPal contributors and the people who throw me a tip once in a while. I also take cryptocurrency now, although I'm not a crypto pumper like Bill Holter claims. I do cover cryptocurrency markets occasionally if there's a halfway decent story or interesting information, although lately cryptocurrency prices have been falling. I think as China rolls out their digital yuan, I think that's why. I think that's one of the main reasons why. And, the last thing was marketing. So if you want to read my article on Sandstorm Gold, it is for Patreon account contributors only. It is behind the paywall over there. So if you're already a Patreon account contributor, if you're one of the 160 people, you can log in and you can read the article. It's about 9 pages. I spent a lot of time working on it. I think it's really good. It's a lot different than anything you'll read on Seeking Alpha for free. The stuff on Seeking Alpha, except for Adrian Hernandez's work over there on Seeking Alpha, he does an exceptional job with his analysis on Sandstorm Gold over on Seeking Alpha. But a lot of the other analysts, there's a couple in particular that you really shouldn't read anything they write about Sandstorm Gold unless you want comedy and you want to laugh because of how moronic. One guy was saying to sell the stock at $3.50 a share. He didn't understand anything about the business and how new royalties and streams were coming online with more revenue growth. He didn't understand any of that. I mean, only someone who was delusional and wasn't paying attention could have missed that. But a lot of the articles over there are mediocre. So if you're not a Patreon account contributor and you want to read the article, you can sign up. It's like $5 a month. Help me grow my business and fund the costs of trying to do audio and podcasts, and hopefully I can reinvest some money into improving, maybe go out and get a new laptop soon and some of the other things to improve the quality of this. Maybe one of these days I'll buy a green screen and actually do some videos. Although I'm so bad at technology, I'm so untechnologically savvy, I think like it would probably crash. Okay, well, that's it for right now. Thank you, everyone, for listening, and I'll keep cranking out the unique content. I don't think anyone else is doing any of this stuff that I'm doing. playing you guys audio clips, good analysis, and I will work on getting on more interesting guests in the future.